Hi guys, can you all hear me? Hello? Hello?
Yes, sir.
Oh, okay, thanks. All right, so last week we concluded foreign exchange. Any questions from that? Was it easy? Was it difficult? Was it interesting or useful? Good afternoon. Yeah. 1 minute. Okay. Yeah. Anything you would like to clarify before we move on to the next area?
Sir, I have some question regarding actually from the industry perspective.
From which perspective?
Industry.
Okay. Yeah.
I want to have some clarifications whether in the recent on the repayment of ISB, 1 billion ISB on the same day. Yes, on the same day, the government printed money around. I can't exactly remember 321 billion something.
Yeah.
And the market liquidity level come down by around 59 billion to nearly 0.03 billion. And on the same day, the money printed by increasing the central bank holding and government securities, and the money market rates move up by around 20 basis points. Is this because of the sovereign bond payment? And actually the swap points on the shortage became positive.
Right.
Recently.
After some time.
Yes. Yeah. Is there any relationship? How can we relate those incidents together?
Good. I'm very impressed by your knowledge. Very good. Well, it's like this. The news is not really out. No one exactly knows what has happened because there is no publicly available information. But from what, as you said, rightly said, what transpired, that is what we can assume, right? Because my guess is the reserves are with the Treasury. So now, when the ISP payment comes up, the central bank has to settle in dollars, no?
Yes.
So probably the central bank must be buying the dollars from the Treasury and giving them the rupees, right? So the rupees will go out of the system, and the central bank holdings will drop. Not the holding, sorry, the liquidity levels will drop.
Yes.
Right. So that mops up the liquidity, and the dollars get released, right? So the reserve levels goes down, as well as the money supply in the market.
Right? But to the extent I am knowing, printing money should be related with the reserves.
Yes.
Foreign currency reserves. Yeah. But they said even though 1 billion paid, around 300 something back to our reserves because of the local investors.
300 million, yes.
Yes. Around 200 or 300 million.
Out of the 1 billion, about $200 million was from invested by the locals.
Yes.
Yeah, domestic.
Yes. But I can't exactly relate those figures into one because how can around 700 billion outflow will result in around
1.4 billion.
Yes.
I'm sorry.
And actually on the same day, States banks I don't know that is 3 state banks together. There was outflow from the financial system, rupee terms, in rupee
Yes.
terms.
Yes. So definitely for the ISB repayment.
Yes, repayment, I assume that they will purchase dollars. What is it in the shortage? I don't know. I can't exactly tell that. Around 50 billion something outflow from rupee outflow. There was a rupee outflow,
Yeah.
and
So liquidity dropped by about 50%.
yes, liquidity drop, but
Yeah.
mop
Because,
up of the liquidity is less than 20 billion.
okay.
After drop of liquidities, 50 billion dropped. I know that was due to the central state banks gave money to the treasury, and that is declined in the market. But day after that payment, only 20 billion is increased as the market liquidity. But the printing money is around 300 billion.
Right. Yeah. So the numbers don't really add up.
Yes.
You mean?
Yes.
Yeah, there must be some adjustments here and there because on top of the ISB settlement, there would have been coupon interest also that would have been paid.
Yes. Yes.
So small portion would have gone for the coupon also. Part of it for the ISB. So that's about 140 billion plus coupon. About
Yes.
maybe another.
I think it's 9%
million.
interest to less than 9% interest.
Yeah, the coupon I think was what 6.5%. I'm not sure.
I don't exactly actually.
Yeah, I can't remember. Anyway, about that means about another $30 million, no?
Yes.
So definitely there was a liquidity adjustment because of the ISB settlement, as you rightly said, and technically it's correct because when the reserves drop, right, when we pay the ISB, the reserves also drop now from 4 billion, might could have dropped to 3 billion. So with that, the interest rates should also go up. Right?
Yes, around 20 basis point.
Yes. And
Overnight rates, yes.
Yeah, that's in line with the
15 basis.
drop in liquidity also.
Yes.
Yeah. So if reserves drop further, then there might be further pressure on interest rates.
Yes.
As well as the exchange rate.
By after that, by 2 basis points daily weighted average overnight rates increased.
Went up, yeah.
Yes.
Yeah, and well, the good news is there is some dollars coming in the form of swaps. And as you said,
they said that 4
ISB
billion reserves include that swap. I think 400 million swap.
Okay, 400 is from
India. Yeah.
Then there is another $1.5 billion swap also. No? China
one. Renminbi.
250 million from Bangladesh. Yeah. So hopefully, well, ideally, the swap should be the short-term solution, right? Because long-term, we definitely have to push for FDIs. But until the FDIs start coming, it doesn't come overnight, right? It's a process. We have to go through a process, build investor confidence that the country is stable, the economy is stable, and all that. So it will take some time, maybe 6 months to 1 year. Until that, the FDIs materialize, then we have to make use of the swap lines, right? Because swaps can be costly.
Yes.
It can be an expensive exercise. So hopefully things will fall in place, right? Once the vaccination drive is in place, once people are vaccinated, at least 50 to 60% of the population is vaccinated, then the country is safe to open up. Tourists will start coming in, and with that, we might be able to push for FDIs. Very crucial. And then the port city is also coming up. So there's a lot of hope. Right. So my guess is we will get through this. It's just this temporary short-term phase that we have to manage. Long-term, well, there is light at the end of the tunnel, fortunately. Right. But the important thing for you guys is now with the FDIs coming in, there will be lots of opportunities created also. Right? The port city is coming up. Plenty of opportunities, right? Lots of foreign companies will come and set up offices within the port city and in and around Colombo. Now that will create lots of opportunities, lots of jobs. So the locals also have the ability to go and work for these in these places, and they will go after the best of the best. They will find the cream, and they will probably headhunt and take you all. If you're good enough, they'll pick you and put you in some of the offices at premium salaries. Right. So this is why it's very important that you get your qualifications in place, have them in place, be ready, so that those job and those opportunities will not go to foreigners. Right? The locals should benefit. Very important that, as Takshira was doing, she has read a lot, she knows a lot about the markets. Very important that all of you also fall in line. You should understand what you are doing, get better at it, and widen the scope. Right now, this lockdown periods that we used to have, work at from home, all that will come to an end one day. But I hope you use the time productively to upskill yourselves, increase your skill levels, increase qualifications, gather more experience, enhance your knowledge, so that you're ready. When the time comes and the economy opens up, there'll be a whole lot of opportunities coming around you. And so grab them with both hands. Okay. So that should be the game plan. Try and enhance your knowledge, read as much as you can. There'll be opportunities. And if you work hard enough, plenty of opportunities will be there. Yeah, so that was a very good point. Thank you for bringing it up. Anything else you would like to discuss? No? So Takshila, I hope I answered at least some of your questions.
Oh, yeah, some of.
Right. Anything else that needs to be discussed before we move on? Right. So the next area is on derivatives. Now, how many of you have never done derivatives? All of you have done derivatives. Right. Are all of you thorough with the concepts? Hello? Can I assume that all of you have studied derivatives at some point?
No, sir.
Sampath hasn't. Anyone else? You want me to start from scratch, or because if you have some knowledge, then we can skip the basics.
Start from scratch.
Okay, good. Yeah, so let's start from scratch then. My argument is that all of you have done derivatives, right? Why? Remember, we did foreign exchange forwards. That too is a derivative. Why? because it's based on it's about the exchange rate on a future date, right? And it's based on the spot rate as well as two interest rates, right? The two interest rates, the interest rates of the two countries. So one way or another, you have done derivatives. And also last week, did we discuss some of your why loans default, why you get bad loans? No? Arbitrage and all we discussed, remember? Well, after 7 days, normally you tend to forget. It's called short-term memory loss. 6 days you remember, then by the 7th day, forget. Short-term memory loss. Now, arbitrage is an interesting concept. Right. Anyway, let's move on to derivatives. Now, how many of you have heard of body mass index, BMI? Body mass index. What does it indicate? It gives an indication of what? You all have never heard. Hello? Yes, so what's body mass index? What does it indicate? It's a person's weight divided by square of his height. So what does it indicate? Nothing?
Yeah, height and weight for the age?
Yes. And you take a person's weight divided by the square of his height, and you get a certain index. No? So what they say is, if I remember right, it should be between 25 and 20, or maybe 30. So if it's more than 25, that means you are overweight. You are overweight and perhaps bordering obesity. But if you're less than 20, it's an indication that you're malnourished. You need to start eating. Okay. So you look at the weight and his height, and you get an indication of whether he's healthy or not. Right. So derivatives are also something similar. Because his health is derived by his weight and height. So derivatives also, in the financial world, derivatives are also something similar. You can use derivatives to, well, one thing is to make profits. Then you can also use derivatives to manage your risk. It's called hedging. To hedge your risks. Okay. Derivative is an instrument. Its value depends on or is derived from the value of another asset, such as stocks, currencies, interest rates, commodities. Well, actually, this list, right, stocks, currencies, interest rates, and commodities, are not an exclusive or not an exhaustive list, because you can structure derivatives practically on anything. Even on the weather. Actually, there are weather derivatives. So depending on weather patterns, you can structure derivatives. Now, these were founded about 400, 500 years ago, mainly to hedge the risk of farmers. Right? So derivatives, they're called derivatives, and they are now widely used in finance. So derivatives, what you should remember is derivatives can be structured on anything. Could be financial derivatives, could be non-financial derivatives. Right? Then when you structure derivatives, there are things called underlying. Right? And the instrument used. Now in this case, body mass index, the underlying factor, when you look at the body mass index, what you look at is actually the health. The health of a person is the underlying thing is the health. Right? And the instruments that you use are the weight and the height of the person. So likewise, when it comes to derivatives, underlyings can be anything under the sun, like interest rates, exchange rates, bond prices, stock market, anything, right? An index, maybe stock index. Right? But there are four basic derivative instruments: forwards, futures, options, and swaps. Forwards, futures, options, and swaps. We'll be studying on those. So the size of derivative markets is massive, much bigger than the foreign exchange market. And derivatives can be for either hedging or for speculating. Hedging or for speculating. Which market do you think is larger? The hedging market is larger or the speculative market is larger?
Speculative market is larger.
Yeah, about 95% of all transactions, derivative transactions, are for speculation. Right? Unbelievable. So why do you use derivatives? Now remember, before you get into derivatives, derivatives themselves, well, derivatives are used to hedge. No? That's what we discussed, right? Hedge means what? What do you mean by hedging? Hedging. What is meant by hedging?
It's a risk mitigation.
Very good. To mitigate your risk. So last week, can you all remember, we did forward exchange contracts? Forward exchange contracts. Right? So just to revise, when you enter into a forward exchange contract, right? Now assume you're an exporter and you're getting dollars. So to cover the risk, if you enter into a forward exchange contract, would you reduce the foreign exchange risk? Are you going to reduce the risk? So discussed last week.
It doesn't reduce the risk.
It does not. So what does it reduce?
The pricing risk.
Yeah, it reduces the pricing risk, the price risk, right? So just because you get into derivatives, it doesn't mean you have reduced your risk. Because derivatives themselves are very risky. It's like, Delipigi and Kirikana, something like that. If you don't know the instrument, then you're getting into trouble. Any examples of derivatives gone wrong?
The hedging deal for done by the CPC, Sri Lanka Petroleum Corporation.
Very good. Now, this word hedging is known by every Sri Lankan. Like you ask a 5-year-old, they also know hedging. Why? Because Sri Lanka has bad experience. CPC hedging transaction. Now, what happened there? Very interesting case study. Right? We have to learn from our mistakes. That's the most important thing. We make mistakes, yeah, fine. But we have to learn from them and move on. Now, what happened in the hedging transaction? Yeah. What happened? So Ceylon Petroleum Corporation, what is their main risk?
Crude oil prices fluctuation.
Yeah. So why is it a risk? Why is it a risk? Why is the crude oil price fluctuation a risk for CPC? Now, CPC is in the industry of petroleum now. They sell petroleum products, right? It can be petrol, diesel, and all that, kerosene. So when they purchase, now their input or what they purchase is crude oil, right? And they might refine and sell petrol and diesel and all that. Yeah, and let's just assume, that they only sell petrol. Okay. So it's now what, 157? Price of petrol is fixed at 157. Am I right? It's fixed, no? They're selling petrol at the price of 157. To make a profit, CPC will have to buy petrol. Okay. So to make a profit, they should buy petrol at a higher price or low price?
Lower price.
Obviously at low price. If they are buying at 120, fine. They make profits. Right? If the cost of petrol for them is 120, they make profits. But the problem they have is their selling price is fixed. Petrol is sold at a fixed price. Once in maybe 6 months or once in a year, they might revise the price, but other than that, it's fixed. Now, if the price of their inputs or crude oil purchases or petrol purchases keep going up, and for as long as it's below 157, no problem. And they will still make a profit. But the moment it goes above, then they start losing money. Yeah. Now, this happened in about 2008-9. Crude oil prices started going up. Remember last week we discussed that crude oil prices went negative. Did we or did we not? We have been in the other class. Did I tell you that crude oil prices went negative? In 2020, there was a time when crude oil prices were negative. Did I tell you that? Yeah. Hello?
No, sir.
I did not. Okay. Right. So let's go back in time, 2008-9. Crude oil prices, like the barrel of crude oil currently is about $65 to $70. 2008, it went to $140, like $140 a barrel. And when it went to $140, everyone thought this is during the subprime mortgage crisis. Subprime mortgage crisis, everything went through the roof, including crude oil, and crude oil prices also hit $140 a barrel. Right? It was about $40 a barrel just before the crisis, picked up and hit 140. Okay. In no time. So everyone thought it will go to $200 a barrel. Now imagine if that had happened and crude petrol prices were fixed at 157. If crude oil had gone to $200 a barrel, the cost of CPC would have gone through the roof. Maybe 500 rupees a liter, isn't it? So the risk of CPCs, as you rightly said, the price of petrol going up. Then when there was expectation that the price of crude oil will go to $200 a barrel, they did the right thing. They did the right thing. They thought they have to fix the price of crude oil. Fix the price. Hedge their risk. Right? So they entered into a derivative. It's called a collar. They entered into a collar, a zero cost collar. We'll get back to that later. And unfortunately, what they did, the mistake they made was they bought a product called an option. When they purchased an option, they did not want to pay for the option, right? When you, for example, when you get your vehicle insured, when you go for a vehicle insurance, you have to pay a premium. So when you buy an option, also you have to pay a premium, right? Now CPC didn't want to pay a premium, so what they did was they bought an option and at the same time they sold an option. And so when you buy an option, you pay a premium, and when you receive an option, when you sell an option, you receive a premium. Right? It's something like this. Now, let's say you bought a car. Right? You bought a car. Let's say this is car. You bought this car. When you buy your car, you have to pay a premium for your vehicle insurance, right? So you go to insurance company, pay the premium. That is fine. Then let's say this is your car, then your friend, your neighbor also bought a car. Right? The neighbor bought a car. Now you want to save money. What you do is, let's say you're paying 100,000 rupees on your vehicle insurance premium. Your vehicle insurance premium is 100,000 rupees. So you don't want to save that. What you do is you tell your friend, your neighbor, that I will insure your car. If something happens to your car, I will pay the damages. Right? But you pay me 100,000 rupee premium for that. Okay. So now I pay 100,000 rupee premium to the insurance company, and my neighbor pays 100,000 rupees to me because I am insuring his car. So my net outflow is how much? My net outflow, premium outflow is how much? Hello? Yeah? Hello? So what is the net premium I pay? Hello? Did you all understand that? Understood or did not understand?
No, sir.
No? This is your car. Okay. Now when you buy a car, you have to pay premium for your insurance, vehicle insurance. Right or wrong?
Correct.
Correct. Right. So you pay 100,000 rupee premium to the insurance company. Okay. Right. Clear?
Yes, sir.
Okay. Then your neighbor buys another car, his car, buys a separate car. Right. So you have one car, your neighbor has bought another car. Now you don't want to pay a premium, right? You want to save your premium. So what you tell your neighbor is you don't go to insurance company, you come to me, you pay me 100,000 rupees, and I will, instead of going to insurance company, you pay me 100,000 rupees, I will insure your car. If anything happens, if you meet with an accident, I will compensate you. Right? So your neighbor doesn't go to the insurance company. I'm just stating a hypothetical scenario, right? Not a real thing. Okay. So all of you don't go home and tell your neighbor that you will insure his car. It's not allowed. It's illegal. But let's just assume it is possible. Right? So you tell your neighbor to pay you 100,000 rupees, and any damage you will pay him. Okay. So you're paying 100,000 rupees for your car to the insurance company, and your neighbor who has bought the BMW pays 100,000 rupee premium to you to insure his car. Right? So this neighbor's car has been insured with you. You have insured with another car, an insurance company. Right? It's your car. You pay 100,000 rupees to an insurance company. And your neighbor's car is insured with you 100,000 rupees. Understood?
Yes, sir.
Yeah. So how much is the net premium you pay?
0.
Zero. You pay zero premium, right? Because you are paying 100,000 rupee premium, you are receiving 100,000 rupee premium, your net outflow is zero. Right? You're paying 100,000 rupees. Sorry, you're saving on the premium. You're not paying a single cent of premium because you're paying 100,000 rupees and you're receiving 100,000 rupee premium. No premium paid. Zero cost. Zero cost. Now let's say your car is worth 10 million and your neighbor's car is also worth 10 million. Right? So for as long as your neighbor drives carefully, he never meets with an accident, that is fine. No? You don't have to pay anything to him. But if that happens, and if your neighbor is careful, you don't have to pay anything to him. But if your car meets with an accident, you're covered. Like your insurance company will pay you. But what if you drive carefully and your neighbor is reckless? He goes and hammers onto something else. Huh? And the vehicle gets condemned. Then what happens?
I will have to pay 10 million.
You will have to pay 10 million. You will have to compensate your neighbor for his damage. Right? So for to save the 100,000 rupee premium, you're risking
10 million.
10 million. Right? So that is what CPC did. That's exactly what they did. They bought an option and at the same time they sold an option. Why? To save the premium. Then what do you think happened to the crude oil prices? It went to 140.
Came down.
Yeah, it started coming down and drastically came down because the Federal Reserve or the US Central Bank did something called quantitative easing. Quantitative easing. Quantitative easing is money printing. When they started printing money, interest rates in the US started going down, and there were lots of investments going into other assets, including commodities. So the price of crude oil all of a sudden crashed. And it came down to about $40 a barrel. Sorry, quantitative easing when they did. Now, when there is uncertainty, right? Uncertainty is there. People tend to invest in safe haven assets like commodities, gold, right? And at that time, gold and crude oil there was a strong correlation between gold and crude oil. So when gold prices go up, crude oil prices also started going up. Then gold went about $2,000 an ounce. Today is higher than that. Crude oil prices also went up to 140. That's what happened during that time. So with quantitative easing, people started getting out of gold and crude oil. They started selling gold, selling crude oil. So gold prices came down. At the same time, crude oil prices also dropped. Now, locally, that led to two crises. One was the pawning crisis, if you all can remember. Pawning crisis in Sri Lanka. 2013, 12, 13, 14, we had a pawning crisis. Can you all remember? I think we discussed last week also. Why some of your customers default? Because they see an arbitrage. We did, right? We discussed last week, remember? The benefit of defaulting is greater than the repercussions of defaulting. Then you default. Every decision, remember we discussed, you will buy this pen because you see an arbitrage, otherwise you will not buy. Okay, so crude oil prices started coming down. It's like your neighbor's car meeting with an accident. Okay, because your neighbor's car is now insured with you, no? So that is what happened to CPC also. When crude oil prices came down, they had to compensate for the drop in price to the other party, to the banks. There were about 5 banks, I think 3 foreign banks and 2 local banks. Right. That's what happened. And there were thundering losses. Then they went to arbitration. Huge legal process. Okay, so that is the risk of getting into derivatives. If you don't know the product, if you try to cut corners here and there, you're taking on massive risk. It's like insuring your neighbor's car. What you may have done probably is you can insure your neighbor's car, but you can probably reinsure it also. Okay, what you do is you get him to pay you $100,000 and you reinsure with another party. Maybe you pay $90,000 to reinsure. Okay, so if your neighbor meets an accident, you will cover him, but then the reinsurance company will cover you. Now, CPC didn't have such an arrangement. They lost a lot of money. So CPC is not the only thing that went wrong with derivatives. They're not the only company or the only institution that suffered. Not only them. There are so many other examples. So many examples. The best case I could remember. Now, sorry, before we go there, CPC is owned by whom? Who owns CPC?
Government.
The government owns CPC. Right? So when they make losses, when CPC makes losses, who bears the loss?
Public.
Yeah, the government, right? The government bears the loss, and the public funds the government. So it's eventually you and I. We have to bear the loss. So it's very important that CPC does not lose money. Okay. So that is why from time to time petrol prices and all will have to be increased, so that in the long run we might be able to build a reserve and run the company in a sustainable manner. Okay. Right. So on top of CPC, now in addition to CPC, now in the US, there was a state in California called Orange County. Orange County in California, state in California, small state. Right? It's something like now within the Western province, you have Colombo Municipal Council around it. So likewise, there was a county called Orange County in California. Now, the treasurer of Orange County was a guy. Anyone knows what was the Orange County treasurer's name? Orange County case. Any idea what the treasurer's name was? guy called Bob Citron. Bob Citron. Now, Bob Citron was managing the funds for Orange County. Fantastic treasurer. He had a very simple strategy, right? What he did was he used to borrow from banks short-term borrowings and invest long-term. So he might borrow, for example, at 1% and invest long-term at 5%. So for as long as interest rates remain low, he borrows at 1% and invests at 5%. For as long as interest rates remain low, he will make a thundering profit. But all of a sudden, interest rates started going up, right? And he was leveraged also with derivatives. So this was his strategy basically. When interest rates started going up, his cost went up, and Orange County went bankrupt. Okay, so county in US, in California, went bankrupt. Now, when a county goes bankrupt, it's like the municipal council, Columbus Municipal Council going bankrupt. They will not be able to do any infrastructure development, any social welfare, nothing. Everything comes to a halt. Parks will have to close. Public welfare activities, everything right, has to close. So that is the risk of a government institution going bankrupt. And so this happened in the US, and that is also because of derivatives. Bob Citron made mistakes with derivatives, and interest rates went up. Right? The taxpayers eventually had to settle. So this is another example. So there are so many other examples. There is another example called long-term capital management. So you guys should go home and read this. Well, not we all are already at home. So it's best if you can read this, do some more research, see the downside of derivatives. And what you should understand is derivatives themselves are risky. If you don't use them properly, you can make huge losses, thundering losses, right? But having said that, you can also save money with derivatives if you use them properly. You can reduce your cost, and if you get into the right trading strategy, you will make money also. You can make money also. Okay, so that's about derivatives. Now let's study each and every product in a little bit of detail. Any questions, by the way? Do you all have any questions to ask? No questions? Okay. So why do you use derivatives? To hedge your risk as well as to speculate. Right? Fluctuations in all kinds of financial prices, including foreign exchange rates, interest rates, and commodity prices can affect our earnings. Therefore, we need certain instruments to mitigate these risks, which could be facilitated through derivatives. So you can use to hedge risk, to speculate, to lock in arbitrage profits. Then to change the nature of a liability. To change the nature of a liability. That means, for example, if you had taken a housing loan about 2 years ago, you may have been paying interest rates in the range of about 12%, maybe 13%, or even higher. Then all of a sudden, last year, interest rates started coming down. What will you prefer? to continue paying high interest rates or to pay low interest rates, and you feel interest rates are going down further, will you prefer to pay a fixed rate or a floating rate?
Floating rate.
Floating rate. Then, if you had taken a housing loan 2 years ago at a fixed rate of 14%, a 20 housing loan, you will try to switch from fixed to a floating rate. That can be done using derivatives, right? But the risk is if all of a sudden interest rates start going up, you will lose. If you're stuck with a floating rate, then you need to switch back to a fixed rate. Okay, so switching from floating to fixed has to be done. But what do you think is the main risk there? Even if you switch from floating to fixed, if that is possible, what is the main risk? In your view, what do you think is the main risk? Well, if I ask you all whether you feel interest rates will go up or come down, what do you think? Or will interest rates remain at these levels for some time? What are your thoughts? But if you do a quick survey amongst all of you in class, each of you will have your own opinions. Like some of you will feel interest rates are going up, some will feel interest rates will go down, others might feel interest rates will remain flat. Right? So different people will have different views. Now, how do you know which one is correct? The answer is no one knows. No one knows whether interest rates will go up, go down, or remain the same. Yeah. So taking that call, whether you should switch from a floating rate to fixed rate or fixed to floating, is the crucial decision. When should you take it? If you switch from fixed to floating, you will expect interest rates to go down. But what if interest rates go up? So that is the main risk. Okay, it all depends on your view of interest rates in that case. So likewise, whether to hedge foreign exchange risk by using a forward exchange contract, that also is based on your view of the market. Okay, so if you feel that if you're an exporter and you feel the exchange rate will go down, you probably should book a forward rate. Sorry, now having said that, I just remembered that I forgot the girl's name who spoke just now a while ago. That the swap points have turned positive from negative. Yeah. That is probably because some feel short-term interest rates might increase. Right? So the short-term swap points, dollar rupee swap points, which were negative, that is because dollar interest rates are at 15% and rupee interest rates are at 7%. So all of a sudden, if there's a correction, perhaps that short-term dollar interest rates will go down and short-term rupee interest rates will go up, so that interest rates will stabilize at some level, then the swap point will increase. Okay, so that's on expectation that short-term interest rates will go up, which has been happening. Rupee interest rates, I mean. Right. So changing the nature of a liability. Okay, so based on our discussions up to now, what do you think are the risks of getting into derivatives? The potential risks of getting into derivatives. What do you all think? may be the potential risks of derivatives. Yeah. What are the potential risks of derivatives?
Counterparty credit risk.
Very good. There can be counterparty risk. So like we said, credit risk or even settlement risk. Why? Now, in the case of Orange County went bankrupt. They defaulted, credit risk. Then CPC did not go bankrupt, but they did not settle. So there is settlement risk. They might default for some reason. Very good. What else?
Market risk.
Yeah, obviously market risk. Okay, now last week, as we discussed, just because you get into a forward exchange contract, you will not eliminate exchange rate risk. So you are still exposed to market risk. Then the crude oil example, you're still exposed to the fluctuations of crude oil prices. Yeah, good point. What else?
Liquidity.
Yes. Good. Liquidity risk. So if you get into derivative in maybe currency which is not very liquid, right? So if you're a foreigner and you want to invest in Sri Lanka or any emerging market, this might be one of the biggest risks, liquidity risk. So market is not very liquid. Yeah. What else?
And finally, operational risk.
Good. Why?
Because the systems, failure of system and operations.
Yes. So now some cases, some of our systems may not be geared to handle derivatives, right? Because accounting has to work in sync with what the front office is doing. And when you get into a derivative transaction, accounting concepts might be a little different from traditional accounting. So you have to comply with all these accounting concepts, standards. Maybe the system may not be geared to it. Then there is another example of Nick Leeson. Can you all remember Nick Leeson we discussed in the first class? Nick Leeson. Who is Nick Leeson? Work for which bank?
Barings Bank.
Yeah, Barings Bank. Okay. Thank God someone remembered. Takshila remembered. Usually you forget in 7 days. So what we discussed about 3 or 4 weeks ago, no chance to remember. Fortunately, one of you remembered. Short-term memory loss. Yes, operational risk. Now that in that case, Nick Gleason exerted his authority. He committed frauds. He wasn't supposed to do it. He did it. Then he hid all of his losses in a fixed account. He created accounts in the system. All that is operational risk. Right. Now the case of Barings Bank. Barings also went under. Why? Again, a classic case of derivatives. Derivatives got backfired on them. He went into what he did was he started selling straddles. Right? He started selling straddles, short straddle, like CPC did. It backfired on him. He started making losses on his short positions. Operational risk. Now that the case of Barings Bank is a case of credit risk, liquidity risk, market risk, operational risk, all those in one. It's a deadly cocktail of derivatives going wrong. Cocktail of derivatives. Cocktail of risk, sorry. And the bank couldn't withstand the shock. Just went under, crashed. Operational risk. There are other risks also. Things like legal risks. Legal risks. Because if there is default, you might have to sue the party. Remember, a CPC case, they have arbitration cases filed. There can be legal risks. Then there can be regulatory risks. Regulatory risk. You might breach regulations if you get into derivatives. So in some jurisdictions, derivatives are sometimes not allowed, not permitted to get into derivatives. Sometimes allowed with certain restrictions. Now in Sri Lanka, if you do derivatives, there are certain reporting that needs to be done to the central bank. So there can be regulatory restrictions. If you violate them, you can get penalized. A reputation risk. Right, reputation. Your reputation goes over 6 months. You get into a derivative, then you back off all of a sudden. Your reputation will suffer. No one will be willing to do transactions. So you're exposed to reputation risk as well. You all agree or disagree? Yeah, any questions on this? No questions? Now you know the risks. If you know the risks, the next step is to mitigate the risk. How can you mitigate risk? How can you mitigate counterparty risk? How can you mitigate counterparty risk? When you give a loan to your customers, what do? Customer applies for a loan. What is the first thing you do? You will do a thorough evaluation, isn't it? Credit evaluation. It involves checking the crib, things like that. You have to do your home groundwork. Credit evaluation. Market risk. You need to keep monitoring the market. Liquidity risk. Again, you need to keep monitoring. Then perhaps you have to get into markets which are liquid. So be selective with derivatives. Operational risk, you will have to have certain controls in place. Things like goal controls. Like Nick Mason, you segregate his duties. Segregation of duties. Legal risks. Most important thing is you need to have an ISDA in place. ISDA. What is an ISDA? What do you mean by an ISDA? An ISDA agreement. ISDA master agreement. ISDA master agreement. International Swaps and Derivatives Association has issued an agreement which all parties should have when they get into derivatives. So before you get into a derivative transaction, you need to have your ISDA in place. Without an ISDA, don't get into derivatives. So like regulatory risk and reputation, you need to have proper compliance policies in place. And compliance. You need to comply with regulations and you need to comply with rules and regulations so that your reputation will not suffer. Okay, so any questions? Derivatives can be highly risky for small and inexperienced investors. They can be massively leveraged. The notional values can be massive, large notional value. Another technical term, what do you mean by notional value? what is notional value?
Value of the underlying asset.
Yeah. Now, if you take a housing loan, a 10 million rupee housing loan at a rate of 7%, interest will be calculated on which value? On the 10 million. Or the outstanding amount. So that is called the notional value. The value which is the basis for all calculations is called notional value. Right? So all calculations are based on the notional value. Right? So categories of derivatives can be used in any market, whether it's interest rates, commodity prices, foreign exchange, even the weather, as I said, right? You have also things like pork belly futures, sugar futures, things like that. Credit derivatives. Now, this is what caused the subprime mortgage crisis to a large extent. Credit derivatives or credit default swaps, collateralized debt obligations. Okay, so these are the instruments which led to the subprime mortgage crisis. They were used excessively. Credit default swaps got triggered, and now credit default swap means it's an instrument which has absolutely no payout unless there is a default, right? So for if there is no default, then the bank which has hedged itself will keep paying a premium to not a premium, actually it's a one leg of the swap to the counterparty that is hedging, right? But if there is a default, then the hedger has a problem. He has to settle. He has to compensate for the loss. So when subprime mortgage crisis hit, that is what actually happened to Lehman Brothers. The credit default swaps got triggered. At Lehman Brothers, then insurance companies like AIG, it almost crashed. The reason is credit default swaps got triggered. They ran out of liquidity. Now, liquidity is the fundamental reason why even Barings Bank defaulted. Okay. So interest rate derivatives, you have the same products, forwards, futures, options, and swaps, commodity, equity, foreign exchange. With all these instruments, you have forwards, futures, options, and swaps. Okay. So derivatives will be primarily based on these four instruments: forwards, futures, options, and swaps. Right, options. How many of you have done options? So none of you have done options. I will dispute that answer. I will say that all of you have done options. Because if you grant a loan. If you disperse a loan or if you take a loan, you have got into an option. Right? So we'll get back to that discussion later on. For now, let's see what an option is. Okay, I will try and explain using an example. July 31st. Let's assume today the price of a mango right. 31st July, the price of the mango, let's say, is 100 rupees. Today, the price of a mango is 100 rupees. And let's say you want to buy mangoes not today, but in 1 month, right? You have a requirement to buy mangoes in 1 month. On 31st August, you need mangoes for some reason. Right? But if you can't buy mangoes today, perishable and all that, and you have no place to store them, you don't have the freezers and all that, so you don't want to buy mangoes today. You want to buy on 31st August. Today, the price of a mango is 100 rupees. Now, what is your risk? You want to buy mangoes on 31st August, what is your risk? The price of mangoes going up is a risk or going down is a risk?
Going up.
Going up is the risk. Right? So what you do is you come to me and you ask me whether I can offer you mangoes on 31st August. I will tell you yes. And then you will want to fix the price of a mango on 31st August. Right? 31st August, at what price I can offer you mangoes. So I will tell you, I will give you mangoes on 31st August at a price of 150. So you can buy mangoes from me at a price of 150. Right? 150 rupees. Then I give you a small sweetener. I want you to buy mangoes from me. I give you a small sweetener. I tell you that on 31st August, you can buy mangoes from me at a price of 150. But that is at your discretion. If you want, you can buy from me. Otherwise, you can buy in the market. You can buy mangoes from the market. So I'm giving you a choice. I'm giving you an option. Either you can buy mangoes from me. If you buy mangoes from me, you have to buy at 150. Or you can buy mangoes from the market. Doesn't matter. Right? Now, I have given you a benefit now. Because I have given you a choice. You can, if you want, you can buy from me. But you have no obligation. You can, if you want, buy from the market. Right? No obligation. It's not like getting married. It's like having an affair. If you want, you can buy from me. Otherwise, buy it from the market. No obligation. Right? So if I have given you a benefit, there is no free lunch. No? I will charge something for it. Right? I will charge. For that benefit, you have to pay me 10 rupees. So today, you are paying me 10 rupees. I will charge you today 10 rupees. For this benefit, I will charge 10 rupees. The 10 rupees I'm charging today itself. Now come 31st August, you will buy mangoes from me at what price?
150.
150. Right. So if the market price of a mango on 31st August is 200 rupees, market is 200.
Sir, could you repeat the benefit part?
Benefit part, this one.
The 10 rupee part.
Yeah. Now, I'm not holding you to this now. I have given you an option, right? I have given you a choice. And you can either buy mangoes from me. So if you buy from me, you have to buy it at 150 rupees. But there is no obligation. You can, if you want, you can buy from the market, right? So I'm giving you a choice, isn't it? Which is a benefit to you. Because if I told you that you have to buy, if you agree to this price, you have to buy it from me, I'm not giving you a choice. Isn't it?
Yeah.
Isn't that a benefit? Because there is, I'm not holding you. If you want, you can buy from me, otherwise you can buy from the market. It's like this, something like this. Right? Now, when you all get married, you have no choice. You have to live with the spouse. But if you give an option to the spouse that you can either live with me or you can go with someone else, is that a benefit or not a benefit?
Benefit.
Benefit. Exactly. So this is also a benefit. I have given you a benefit. You can either buy mangoes from me or you can buy from the market, from someone else. Benefit, no? Yeah.
Got it.
And for the benefit, I will charge. No free lunch. If I give you a benefit, I will charge for it. Okay, for that I charge 10 rupees. Understood? Right. So 31st August.
So the seller charges 10 rupees for, because he gives the benefit.
Yeah, I'm selling to you all. I'm selling. I'm the seller. You come to me and ask me what price I'm willing to sell mangoes on 31st August. I tell you at 150 rupees, but no obligation. You don't have to come in. And there is no obligation. If you want, you can buy from me. Otherwise, you can buy from anyone else.
Right.
If you buy from me, I'll give it 150. I'm not holding you.
Yeah.
Right. So
the 10 rupees charge, the 10 rupees charged at the time of getting into the.
Today itself, I'm charging.
Right.
Right, because I'm also taking a risk now. I don't know what the price of a mango on 31st August is going to be. If it's 200 rupees, I will sell it to you at what price?
150.
150. Committed. No? I am committed.
So it's like you need 10 mangoes by the 31st of August,
Yeah.
and the seller promised to pay sell it for 150,
Yes.
and he gives this benefit charge of 10 rupees. So I have to pay 100 rupees to him today.
No. Today the price of a mango is 100 rupees, right? This is just the spot price of a mango.
No. What I mean is 10 rupees into 10 mangoes.
10 rupees into 10. Yeah, correct. Yeah, for each mango, I charge 10 rupees.
Yeah. Right. Okay. Got
For
it.
each mango.
Yeah.
Okay. We're just talking about one mango for simplicity. Clear? Understood?
Yes, sir.
Okay. If you have any doubts, just ask. Right. So the market price of a mango on 31st August, if it's 200 rupees, what will you all do? Will you buy from the market or will you come to me and buy at 150? Or will you buy from me? You buy from the market or buy from me? You buy from where? 31st August, if the price of a mango is 200 rupees.
Seller.
Yeah. Well, I'm the seller, right? You buy from me, right? 150 rupees. How much will you pay? Buy from the market or buy from
160.
No. You're paying 150. I have agreed to sell at what price?
150.
150. Right? So you are buying from me at a price of 150 rupees. So you make a profit or a loss out of this transaction. If you buy from me, if you buy from me at 150 rupees when the market is 200, you make a profit, isn't it? Right or wrong?
Right.
Yeah. What is the profit? How much?
40.
Yeah, you're right. Right? Market is 200 rupees. If you had bought from the market, if this agreement was not there, now we have signed an agreement. I'm signing an agreement that I'm selling it to you at 150 rupees on 31st August, but there is no obligation. Right? But you have to pay me today 10 rupees in advance. Today itself, 10 rupees you're paying. Because there is no obligation. If there was an obligation from you also to buy, then I will not charge this 10 rupees. For that benefit that I have given, I have charged 10 rupees. So on 31st August, market price is 200 rupees. You buy from me at 150 rupees. Straight away, you save 50 rupees. But today, 31st July, you have paid me 10 rupees. That's also a cost to you. Meaning, you will make a profit of 40 bucks. Correct? Right or wrong?
Right.
Yeah. Then if the price of a mango on 31st August is 180, what will you do? Will you buy from the market or will you buy it from me?
Buy from the seller.
At what price?
At 180.
No. Why would you buy at 180? Because I'm offering at what price?
Sorry, yeah, 150.
Yeah, you buy at 150. Right? You buy from me at 150. How much profit will you make? Out of this transaction, you save 30.
20.
Yes, you save 30, but you have already paid me 10, so you make 20. Sorry. You make a profit of 20. Then what if the price is 160? $160. You'll buy from the market or from me? Will you use this agreement or will you buy from the market? $160.
It will not matter.
Why?
Because anyway, no,
Yeah, you're on the right track.
I have all. It's the same price. If I don't have a profit from it.
No, it is not. It is not. Why? It's 10 rupees. What you pay today is already gone.
Yeah.
Right? It's sunk cost. This is sunk cost. Let's forget about it. Now this is a new day. 31st August, will you buy at 160 or will you buy at 150?
Buy at 150.
You buy at 150. How much do you save? You save 10 bucks. You're buying it 10 rupees less than the market, but you have already paid me 10. So you're breaking even. You break even at 160. Clear? Okay, are you all with me? Understood?
Yeah.
Then what if the price is 155? Now what do you do? Buy from the market or buy from me? 155. What would you do? The market price of a mango is 155.
Still buy from the seller?
Yeah, you still buy from me, right? Good. And how much will you save? Market is 155. You can buy from me at 150. So you will save 5 on that transaction. But you have already paid me 10 bucks. So you will overall, out of this transaction, you will lose 5. Isn't it? Then what if the price is 150? 150. Now what will you do? Market price of a mango is 150. Will you buy it from me or from the market?
Still buy from you.
Actually, it doesn't matter. If you buy from the market, you will buy at 150 now. And if you buy from me at 150 still. Immaterial. Right? It doesn't matter whether you buy from the market or from me. You will anyway pay 150. So you make no profit out of the transaction. But you have paid me 10 bucks. So you will lose 10. You will lose 10. Now what happens if the price of a mango is 140? Price of a mango is 140. Will you buy it from the market or will you buy it from me?
From
Buy from market.
From the market, yes, quite obviously, right? Because you don't have to come to me. Because if you come to me, you'll have to buy 150. Market is there at 140. You buy. You don't cite the place. You don't come to me. You go to the market and buy at 140. Right? So you are not using this contract. It's not. It's going to be obsolete. You are not using the contract at all. There is no profit or loss from the contract. But you have already paid me 10 bucks, which is sunk cost. So this transaction will result in a 10 rupee loss for you overall at 140. And if the market is at 100, will you buy from the market or from me?
Market.
Market. 100, right? You don't use this the contract you don't use, but for the contract you have paid 10 bucks, you will lose your 10 bucks. Then if mangoes become worthless, like mangoes become worthless, no one is eating mangoes, 0. Then what happens? You buy from me or from the market? Maybe there is a dansala and people are giving mangoes free. Will you come and buy from me at 150 or will you buy free?
Free.
Yes. You don't come to me. But you have paid me 10 bucks, you will lose it. So what do you observe from this? What are your observations? you will
Losses
use
are
this.
limited.
Losses are limited. Yeah. The maximum loss you will make is how much?
10.
What is this 10?
Premium
what,
paid.
yeah, it's what you are paying me. And you will use the contract for as long as the price of a mango is what? You will use this contract for as long as the price of a mango is
Less than.
if it's less, you will go to the market.
More than.
Yeah. If it's 150 or above, then you will use this contract. Otherwise, you will not use the contract. Yeah, isn't it? So I feel like drawing a graph. Now looking at this, I draw a graph. Huh? This is the profit out of the transaction profit. So let's plot the profit against the market price. The 150 is a crucial point. Anything below 150, and anything below 150, your loss is how much? Anything?
10 rupees.
Yeah, you will lose 10. So at 150, until 150, you will lose 10. And you will break even at 160. 160, you break even. Then you get a linear line where 200 you make a 40 rupee profit. Agreed? Any disputes? So this 150 is a very important point. Clear? Agreed or not? What do you all think? Hello? Do you all agree or disagree? Yeah? Do you all agree with this graph or not? Hello?
Agree, sir.
Yeah. Yes. So you have just done an option. Right? So all these calculations were based on the price of what? Based on the price of? All calculations were done based on the price of?
National price.
Huh?
The price?
No, based on the price of what? The price we're talking is about what? Price of what?
Seller's price.
No. What is the product?
Of the
Mango.
Mango. So mango is the underlying product. Is a mango. Right? You're talking about the price of a mango. That is the underlying. This 10 rupees that you pay me today. The 10 rupees that you pay me today is called the premium. Premium. It's like when you get insurance, you pay a premium. Right? The price that you pay for an insurance is called premium. Isn't it? So this is the premium that you pay. Then 31st August, when the contract matures, it's called the expiry date. The expiry date of this option, 31st August. 150 rupees is called the exercise price or the strike price. The exercise price or strike price, 150. Right, so this 150 is the exercise price or the strike price, 10 rupees the premium. Okay. And what about the profit? How do you calculate your profit? Profit is the market price. No? This is market price minus the strike price minus premium. 10 rupees is the premium. Market minus strike minus premium. So market minus strike price is called the intrinsic value. Intrinsic value of the option minus the premium. Gives you the profit. Right? Remember, intrinsic value will never be negative. It will always be a positive number. It can never be a negative number. Intrinsic value will never be a negative number. It always has to be positive. That is why you don't get a negative number here. So what is your maximum loss? Now, in this case, there are two parties. I am selling this contract to you. And you're coming to me and buying the contract from me. Okay. So you have bought the contract from me, I have sold it to you. If I have sold it, I am short. You are long the contract. So this profit diagram is the profit for you, for the long. But if you take my point of view, right? My point of view, when you make a 10 rupee loss, that is the profit that I make. It is what I charge today. So until 150 rupees, I will make a 10 rupee profit. Anything above that, I will start losing money. Okay? And at 200 rupees, I will lose 40 rupees. So the profit that you make is the loss that I make. If you add the two, it becomes 0. Here you lose 10, I make 10 rupees, the total is 0. At 200 rupees, you will make 40 rupee profit, I will make 40 rupee loss, total is 0. Zero sum game. So if you draw the diagram from my point of view, it will look like this. That's because I am short this contract. I am short. You're long, I am short. Right? This contract gives you a right without an obligation to buy mangoes from me on 31st August at the price of 150. Right? So you are the long, it gives the long the right without an obligation to buy mangoes on 31st August at 150 rupees. Such a contract is called a call option. This is called a call option. And this diagram is called the payoff diagram. Payoff diagram of a call option. What would be the maximum profit? Sorry, this is for the long. I'm talking from the point of view of the long. What is the maximum profit you will make? If you're long this option, what is the maximum profit you will make?
Unlimited profits.
Yes. Why? What is the technically, what is the highest price of a mango? Will it be limited to 200? Or can price of a mango go to 500,000? What is the limit? Unlimited, no? There is no ceiling price for mangoes. That's it. If the price goes to $1 million, and there's only one mango left in the world, and the price of a mango will go to the stars. So the maximum profit you will make is technically unlimited. You can make unlimited profits. Then the maximum loss. What is the maximum loss you will make?
Premium paid.
Yeah, 10 rupees or the premium. You won't lose anything more than that. Your maximum loss is limited to the premium. Right. Then if you are short, the maximum profit if you are short, the maximum profit you make is
Premium received.
premium. And the maximum loss technically unlimited. Like mirror image. Okay, the short and the long have mirror images. So the other thing to notice is anything below 150, this transaction, you will not use a contract, right? Anything below 150, you are not going to use the contract. That is called out of the money. Out of the money. When the market is equal to the strike, it is called at the money. And when the market is more than the strike price, it is called in the money. Out of the money, at the money, and in the money. 3 regions of an option contract. Right. So any questions? Any questions on this? No questions? So this is what you should understand, that if you are long an option, you have a right without an obligation. But if you are short the option, you have only an obligation. There is no right. Because if the long wants to exercise the option, then the short can't say you can't do it. You're committed. So the short is committed. There is an obligation. For the long, there is no obligation. There is a right. Okay. Now the premium is paid from the long to the short. When the long pays the short. Okay. Any questions? Right. So if there are no questions, shall we take a break and come back? Yeah. We take a break and come back. At 4 o'clock. We'll come back at 4. Okay. Right. Okay. So I'll see you all at 4 o'clock. Hi guys, welcome back. So any questions on call options? Right, so that's all about call options. Eh? Okay, so let's move on to the second scenario. Just a quick reminder. Here you wanted to buy mangoes, 31st August. Now what if you have a mango plantation? Mango plantation. In which case you will want to sell. Right, so today 31st July. Price of a mango, let's say, is 100 rupees. And you're expecting your harvest on 31st August. Right, so you want to sell mangoes. So what you do is you come to me and you will ask me at what price I am willing to buy mangoes from you. Right now you're selling mangoes to me. So I will tell you that on 31st August, I will buy mangoes at the price of 80 rupees. I am willing to buy mangoes at a price of 80 rupees. But as in the first case, there is a slight difference by the way. Here I was willing to sell mangoes. Now I am willing to buy mangoes. Right? Whereas you were willing to buy mangoes here, and now you are going to sell mangoes. Now in this case also, I will tell you that if you want, you can sell mangoes to me. Otherwise, you can sell mangoes in the market. Right? So I have given you another option, either to sell mangoes to me or to sell mangoes to the market. Right? For that, I will charge. I will not give free lunch. No? I will again charge. Eh? Let's say this time I will charge 5 rupees. Today I'm going to charge 5 rupees. And you know what this is called? What is this called? The 5 rupees is called?
Premium?
The premium. Right? So my premium today is 5 rupees. Now I'll give you a contract which gives you the right to sell mangoes. There is no obligation. You can sell mangoes here. Right? So I have given you the contract. I have written it and given to you. Okay, you have bought the contract from me, so your long contract, I am short the contract. Okay, so 31st August, if the price of a mango, the market price of a mango is 150 rupees. Market price of a mango on 31st August is 150 rupees. Will you use the contract or will you sell it in the market?
Sell it in the market.
Yeah, you sell it in the market. No? Because if you use the contract, you will sell it only at 80, but the market is going at 150. So you are not going to use the contract, but you have paid me 5 rupees. So you will overall lose 5. Right? So at 150, you will lose 5. Then if the price of a mango is 100, what is the case? You will lose or will you gain? If the price of a mango is 100 rupees, will you use the contract or will you sell it in the market?
Still sell it in the market.
Yeah, you're still better off selling it in the market. No? You get more. Right? So you're not going to use the contract, but you have paid me 5 rupees, so overall you will lose 5. Then at 85, what do you do? Sell it in the market or sell it, use the contract? At 85?
Either way.
No. You're still selling in the market, no? Right?
Yes, it's 85. Yeah, 80.
Yeah. Right, so you'll still end up losing 5. But at 80, you sell it in the market or use the contract? What would you do at 80?
It doesn't matter, isn't it?
Doesn't matter. Either way, you will still lose 5. So if the price of a mango is 75, then what? At 75, what would you do? Will you sell it in the market or will you use the contract?
Use the contract.
You'll use the contract. So you make a profit of? From the contract, you will make $5. Isn't it? Now you get 5 rupees more now. But you have already paid me 5. Right? So you will?
Break even.
Yeah, at 75, you will break even. Then if the price is 60, at 60, if the price is 60, will you sell it in the market or use the contract?
Contract.
Contract. So you'll end up with 15. Right? $20 profit due to the contract, but you have paid me 5, so you end up with 15. Then, if mangoes become worthless, you will still use the contract, no? Price drop to 0. If the price of a mango drops to 0, you will still use the contract, isn't it? you definitely use the contract. So you make $80 from the contract. But you have paid me 5, so you end up with how much?
75.
Yeah, you end up with 75. Now mango prices doesn't go negative now. Okay. So using this information, shall we draw another graph? What is this graph called? Where you put the profit against the market price. It is called the payoff diagram. Strike price is 80. Anything above the strike price, right? Anything above the strike price, you will
Lose.
you will lose how much? 5.
Maximum 5.
Yeah. Above the strike price, you will lose 5. Then the break even is at 75. And when the price is 0, you make $75. So this is the payoff diagram. And this is if you are long the contract. Once again, your profit is my loss and your loss is my profit, right? So again, I'm short the contract. So I have the mirror image. This is for the short. Okay. Then any price above 80, the contract doesn't get executed. So it's called out of the money. And at 80, it's at the money. Anything below 80 is called in the money. So let's look at the profit. You're long, your profit would be, it's a strike price minus market minus the premium. Slightly different from the previous one. Right? Earlier it was market minus strike, now it is strike minus market. Strike minus market is called the intrinsic value, which can never be negative. So if you're long, your maximum profit. If you're long, your maximum profit would be what? Limited or unlimited? if you're long, your maximum profit in the earlier case, your maximum profit was unlimited. But now,
limited, no? 75 maximum, limited.
yes, right. Maximum profit you will get. Now, strike price doesn't change, premium doesn't change. The only thing that will change is the market. Right? When the market is zero, you will get the maximum profit. So your maximum profit technically will be strike minus premium. And maximum loss is the maximum you will lose is 5, yeah, which is the premium. Then if you're short, your maximum profit would be the premium mirror image. Right? It's the premium. Maximum loss will be the strike minus premium. Okay. Any questions on this? Yeah. No questions? Any questions? Right. So the next concept. Sorry. Before we go there. Now the second contract. And again, the underlying was the price of a mango. And it gave you the right without an obligation to sell mangoes at 80 rupees. Right? A right without an obligation to sell the underlying. That is called a put option. So here we have a call option and this is a put option. These are the two main types of options, call option and a put option. Right. Any questions? So call option is a contract which gives you the right without an obligation to buy the underlying. And put option is a contract which gives you the right without an obligation to sell the underlying. Clear? Okay. Right. So those are two types of contracts. Now, in this case, right, you can exercise the contract only on 31st August. Then what if I give you a contract which you can exercise anytime in between? Right? Anytime in between 31st July and 31st August, any day you can exercise. Whenever you want. Okay. That kind of a contract, right? If I give you a contract which can be exercised anytime in between, it is called an American option. American option can be exercised anytime in between, anytime before the option maturity, option matures. Whereas if the option can be exercised only on the maturity date, it is called a European option. Can be exercised only on the maturity date. American option can be exercised anytime in between. European option can be exercised only on maturity date. Yeah. So the next question. Next question. If let's say the premium for this European option is 5, right? And if I structured an identical American option for you, what do you think will happen to the premium? Will the premium increase or will it reduce? For an identical American option, will the premium be higher or lower?
Higher premium?
Yes. Why?
Biosen has more benefits.
Yeah. Why?
Option Biosen has more benefits.
Yes. Very good. Very good. Now, which one is more flexible? The American is more flexible or European is more flexible?
American.
American is more flexible. Right? So higher the flexibility, higher the price. Now, higher the features, higher the price, isn't it? So that is why a Mercedes-Benz might be more expensive than maybe a Maruti or a Toyota, and because it has more features. Okay. Remember, American options are more expensive than identical European options. Right. So the next thing is the price of an option or the premium. Okay. Sorry, before we go there. Now, can you all look at this, what we just did, and tell me what would be the riskiest thing you could do with options? What is the riskiest thing you could do with options?
Short call.
Yeah, why?
Profits unlimited.
Very good. The riskiest thing you could do is where your loss is maximum. Short call. Selling the call option is the riskiest thing you could do. Good. Okay, so let's look at the price of an option or the premium. Price of an option. The option premium depends on several factors, right? One is the price of the underlying. Then it depends on strike price. Depends on interest rates. It depends on the time to expire. It also depends on volatility. Price of the underlying interest rates, time, volatility, and the strike price. So what sort of an impact do you think the price will have on options? Meaning higher the strike, higher the price of the underlying, higher the premium, or lower the price of the underlying, higher the premium. How does it work?
Positive correlation.
Positive. Meaning higher the price of the underlying, higher the option premium. Okay. Now I'll explain using an example. So if you are buying this pen, you will benefit if the price is as low as possible or as high as possible. You will have more benefit if the price is 1 rupee or if the price is 1,000 rupees.
Lowest.
Yeah, as low as possible. Okay. So having a low price is a benefit to the buyer. Okay. So lower the underlying price, higher the benefit for the buyer. Okay, so if the benefit is higher, then the price is also higher. Okay. The call options will have a higher premium when the underlying price is lower. Meaning it's an inverse relationship. Call options will have a higher premium when the underlying price is lower. Right. But if you are buying this pen for 1,000 rupees, then the premium will be less. Okay. Because if you structure a call option on this pen at 1,000 rupees, and you structure a call option on this pen at 1 rupee, when the price is 1 rupee, the option premium will be higher. But when the price is the call option premium will be high. But when the price is 1,000 rupees, the call option premium will be less. Right? So there is an inverse relationship between call option premium and the price of the underlying. But when the underlying price is high, you benefit if you sell. Okay. So put option premium is high when the underlying price is high, and put option premium is low when the underlying price is low. So here you will have a positive relationship. Okay. Because you will prefer to sell when the price is high. No? When this price is 1,000 rupees and you want to structure a put option, then you will have to pay a higher price than when the price is 100 rupees. So there is a positive relationship between underlying price and put option premium. Then the strike price. Lower the strike price. Right? Lower the strike price. What do you think? Higher the premium for a call option or lower the premium? Yeah, lower the strike price. What do you think? Lower the strike price?
Higher premium.
Very good. Yeah, lower the strike price, higher the premium. Because call option gives you the right to buy. When the strike price is lower, you will benefit more. Right? So lower the strike price, higher the premium. Meaning, again, inverse relationship. Whereas for put option, higher the strike price, higher the premium, right? Because you will prefer to sell at a higher price. So higher the strike, higher the premium than a low strike. The low strike will have low premium, high strike will have high premium. So the first point, the easiest way to understand when it comes to price. Now look at it with an insurance, vehicle insurance. Okay, your insurance premium will be high when the value of the vehicle is high or when it's low. Yeah. Insurance premium will be high when the value of the vehicle is high or low.
High.
When it's high. Right now, what happens when you insure? If you meet with an accident and the vehicle is condemned, you sell the vehicle to the insurance company and they will pay you the assured sum, right? Yeah. So you are selling the vehicle, meaning it's like a put option. Yeah. When you are selling the vehicle, if the vehicle price is 10 million, you will end up paying a higher premium than when the vehicle price is 1 million. Okay. So higher the price of the vehicle, higher the premium, like a put option. Then if the vehicle price is 10 million, vehicle price is 10 million, and you have insured only, let's say you insure 10 million, right? You insure 10 million in one case. The other case is you insure only 1 million. In two scenarios, the first scenario you are insuring 10 million, full insurance. Second scenario, you are insuring only 1 million. The premium will be high in which case?
10 million.
10 million, yeah. So higher the strike, higher the put option premium. Like insurance is like put option. Then what about interest rates? Interest rates have a positive relationship for both call options and put options. Okay, so if interest rates increase and you are going to ask for a insurance premium, the premium will be higher than interest rates are than when interest rates are lower. Okay, so when interest rates go up, your insurance premiums will also go up. Likewise, option premiums will also go up when interest rates go up. What about time period? What do you think is the relationship? Longer time period, higher the premium, or shorter time period, higher the premium? Negative relationship or positive relationship?
Positive.
Yeah. Positive relationship, right? Again, if you are doing a vehicle insurance and you are insuring a value of 10 million, your premium will be low if you insure every month or if you insure for 1 year. If you insure for 1 month, the premium will be low. If you insure for 1 year, the insurance will be low. Premium will be low.
One month will be low.
Yeah, shorter time period, lower the premium. At longer time period, higher the premium. So both have positive relationship to time. Then what about volatility? Now, volatility is a measure of risk, right? It's a measure of risk. So if you're with your vehicle, your insurance premium will be high if you're a risky driver or if you're a safe driver. If you meet with accidents every day, or if you never meet with accidents, two guys, one guy meets with accidents every day, the other guy never meets with an accident. So if they insure in the same vehicle, insurance premium will be high in which case? When the risk is high or the risk is low? When the risk is high. That means when volatility is high, right? Volatility is a measure of risk. So when the risk is high, the premium is high. Positive relationship. So this is how it works. Yeah, easy to remember because every case is a positive relationship except when it comes to call option, the underlying price, and the strike price. Other than that, every case it is positive. Clear? Any questions? No questions? Then option settlement. Right. Okay, let's go back to our mango example. That was July, 31st August, right? Call option, strike price 150. Okay. Now on 31st August, this call option will be exercised if the underlying price is more than 150 or less than 150. This option will get exercised if the price is
More than.
more than 150. Right? Okay, so let's see on 31st August, if the price is 200 rupees, it will get excised, isn't it? 31st August, if the price of a mango is 200 rupees, this call option will get exercised. Correct? That 200 rupees, it will get excised. Now let's assume that 31st August at my name, the price is 200 rupees. Okay, then by 3 p.m. the price is 100 rupees. So now what will happen? Which price would you use? Do you use 200 or do you use 100? Or do you use an average? Which price would you use? Yeah. Which price would you use? What do you think? The way it is done is, it will be very specific, right? It will not, your contract will not say 31st August, strike price 150. It will be a little more specific. It will go on to say that 31st August, 3 p.m. Colombo time or 3 p.m. Tokyo time. It's called Tokyo cut or New York cut. At that particular time, the price in many market, something like that, right? The price in Tokyo market. It will be very specific. So there will be no doubts at all. No doubt whatsoever. Time will be given. And so if it says 3 p.m., then you have to wait until 3 p.m. to decide whether the option gets exercised or not. Clear? So options can be physically delivered or cash settled. Meaning, let's say 3 p.m. the price is 200 rupees. 3 p.m. price is 200 rupees. So the strike price is 150. This call option will get excised or will not get excised. Will it get excised or not? Yeah. So this call option will get excised or not? Yeah. Hello. If the market price is 200, will this call option get exercised or will it just expire? Hello?
Option exercise.
Yeah, option will get exercised, right? So if the option gets exercised, there are two ways of doing it. One is if I'm short the option, when I'm short call option, and if you're long call option, I can do two things. One is I can give you a mango. That is called physical delivery. Right? I give you a mango. Now what happens is on 31st August, you pay me 150 rupees and I give you a mango. So that's called physical delivery. Why? Because you're giving me 150 rupees and I'm giving you a mango. The price of a mango on 31st August is 200 rupees. But you have paid me only 150. So you make a profit straight away of how much? You can take this mango and sell it in the market at 200 rupees.
50.
Yeah, so you make a profit of 50 rupees. Right? If I give you a mango, you can go and sell it in the market straight away and you make a 50 rupee profit. Right? The other thing I can do is I can straight away give you 50 rupees. I don't have to give you a mango. I can just give you 50 rupees. If I give you a mango, this is called physical delivery. That's one way of settling, giving a mango. And if I give you 50 rupees, it's called cash settlement. Cash settlement. Clear? Do you have any questions? So options can either be physically delivered or any derivative can be physically delivered or cash settled. Physical delivery versus cash settlement. Okay, so let's try these questions. Shall we try these questions? First one is you asked to calculate the value of the following put options and draw the payoff diagrams. Right. So put options, payoff diagram. Payoff diagrams are standard. So this is right or wrong, what I just drew. What I drew is right or wrong? It's wrong. What have I drawn? This is what? Yeah, long call option. Okay, last master draw put option. First one is long put. Long put, strike price 100, premium 4. Stock price is 90. So this option is in the money, out of the money. It's an in the money option. Right. And your profit will be right minus the market minus premium. Strike 100 minus market 90 minus the premium of 4. You end up with a $6 profit. Correct? That's part 1. Part 2, you're short, strike price 100, short put, strike price 100, premium is 4, which means this is the mirror image. Stock price 110. So at 110, you make a $4 profit. Agreed? You all agree? Yeah. Can we move on? Next example. Premium 4. Stock price 9. So at 90, you will lose $4 if you're long. Second one, you're short. Strike price 100, same thing. Premium 4. Stock price 110. So if you are long, you have been long, your profit will be the market minus strike minus premium. It's at 110. Market is 110 minus strike of 100 minus a premium of 4. So that is 10 minus 4, 6. But here you are short at 110. So the profit is minus 6. Because it's the mirror image, right? So at $6, so at $110, market is 110, you make a loss of $6. Clear? Any questions? No questions? Okay. Next question. A Sri Lankan exporter will receive 1 million yen in 3 months. He expects the current yen to rupee rate of 84 to increase to 90. What is the protection he can get from option strategies if his view does not materialize and the yen rupee rate increase? Right. So it's a Sri Lankan exporter. How will he benefit? go through the question again. Sri Lankan exporter will receive 1 million yen in 3 months. Right, so he's an exporter and he's receiving yen. So he will benefit if the exchange rate goes up or goes down.
Goes up.
Yeah, if the exchange rate goes up, he will benefit. Three months, rate is 84. If the rate goes up, he benefits. He expects the rate to increase from 84 to 90, which is good for him. Right? So if the exchange rate is going up, he will benefit. What is the protection he gets from an option strategy if his view does not materialize and the exchange rate increases? If the rate doesn't go up, right? If it doesn't go to 90 and if it goes to 75, he will lose. So how can he benefit from this? How can he use an option in this case? Now he's getting yen, right? So he needs an option which gives him the right to sell yen without an obligation, the right to sell yen, right? So which option will give you the right to sell yen? Which option will give you the right to sell yen?
Put option.
Put option, yeah. So he needs to buy a put option on the yen rupee, right? Put option to sell yen. So he has to go long put option on yen, on JPY, on the yen rupee rate. He has to go long a put option on the yen. Okay, so he has to buy a put option which gives him the right to sell yen. And the strike price should be out of the money at 75. Okay, so if he does this or at 80, anything out of the money. If he does this, he's safe at 80. Okay, so if the price drops below 75, he can sell it at 75. But if the price goes up, he gets the benefit. And so his downside is protected at 75. That is what he can do. Clear? Next one is on option premium. So option premium is equal to intrinsic value plus time value. Now intrinsic value we did. Remember, for call options it is the market price minus strike price. For put options it is strike minus market. And the intrinsic value
Excuse me,
will never be negative. Yeah.
in the last example, how that 75 comes, it is just decided.
75.
Yes.
He has to buy an out of the money option, right? Because if he buys an in the money option, it's going to be expensive. The premium is going to be very high. Okay, so his intrinsic value, he has to make it 0 or less. He has to make the intrinsic value 0, which is the area where next. When you buy options, you always need to buy out of the money options. If you buy an option with in this case put option strike price at 100, it will be in the money, and you will get hammered on the intrinsic value. The option price will be very high. So always buy an out of the money option. Now the spot price is 84. For it to be out of the money, the strike price will have to be less than 84. Right? Put option will get exercised if the market comes down, right? So if the strike price you put at 100, it is in the money. To be out of the money, it has to be less than 80. You need to buy an out of the money put option. The strike price anything below 84. But anything below 84.
Okay. That is HTTP short movie, not long.
Sorry. Line is not clear.
And exporter should be short, not long.
No. He should go long put option. No? He needs to buy an option which gives him the right to sell. No, right? He has to be long put option. He has to buy the put option. Right? He buys the put option, and the put option gives him the right to sell. So the first thing is he has to buy the put option. Okay, he has to be long put option. Yeah. Okay. Any more questions? Right. Option premium is the intrinsic value plus time value. Intrinsic value we discussed. Time value is the value of an option with the passage of time. Right. So when the option reaches its maturity, the time value drops to 0. Otherwise, the time value is positive. Something like this. Okay. Starts here and drops to 0 when it matures. This is the expiry. Okay, so the option premium is intrinsic value plus time value. Let's try this example. The following prices were reported in June 2014 and December 2014 call option on the shares of ABC. The price of the call option or the premium is 35.75. Premium was 35.75. Strike price 66. Spot price 80.75. You have to calculate intrinsic value and time value. Okay, sorry. It's a call option. So intrinsic value will be the market minus strike. Market is 80.75 minus the strike price 66. You end up with 14.75. Time value, premium is intrinsic value plus time value. Intrinsic value is 1475. Premium is 3575 plus time value. So time value is $21. Second question is the money option in the money. The answer is yes. Option is in the money. Why? Why is this option in the money? Why do I say this option is in the money? Because this option is in the money because the intrinsic value is positive. You have positive intrinsic value. It's not zero, right? So if intrinsic value is positive, that means the option is in the money. Clear? Any questions? Right, so if there are no questions, let's wind up for today, and next week we'll have our last class. Yeah. So thank you very much. Stay safe. I will see you all next week.
Sir, excuse me, sir.
Yeah.
Sir, I have a small question. Physical delivery and cash settlement, what is the difference?
Physical delivery.
Cash settlement, there is no physical delivery.
No, cash settlement, there is no physical delivery. Instead of giving the mango, if I give you the 50 rupees, that is called cash settlement. Right? Because I give you the net impact. I don't give you a mango physically. Because even if I give you a mango, you make 50 rupees now. So without finding a mango and going through all that hassle, I give you cash straight away. Right?
Yeah, is
Clear.
it possible in every case? So
Yeah, it's possible in any option contract.
without giving the commodity, can we settle the cash?
Without giving the commodity, you can. Most, about 99.9% of all derivative transactions are cash delivered, cash settled, not physical delivery.
Oh, okay.
Yeah.
Okay, sir, thank you.